Welcome. Listening to books is important. It saves time. You learn while driving, walking, or resting. But here's something different. During this audiobook, secret messages are hidden. You will find them only if you listen carefully till the end. These secret messages will change your life forever. They will improve your decision-making, problem-solving, leadership qualities, communication skills, thinking ability. All of this will get better, so get ready. Today we talk about a new book. This book will change our lives forever. Listen all the way. Find the secrets. Let's begin.
Let's start the book. The Psychology of Money. Introduction. Wealth is about behavior, not brains. We often treat money as a strict mathematical discipline, assuming that complex formulas and detailed spreadsheets hold the ultimate key to financial success. Yet, in the real world, ordinary people do not make life-altering financial decisions by staring at a spreadsheet. They make them at the dinner table, in chaotic business meetings, or during sleepless nights, heavily influenced by their own unique pride, ego, and personal worldview. Morgan Housel's brilliant masterpiece, The Psychology of Money, flips the traditional financial script completely upside down by revealing a profound truth. It demonstrates that doing remarkably well with money has very little to do with how intellectually smart you are, and absolutely everything to do with how you behave. This comprehensive summary will unpack the hidden psychological forces that secretly drive our daily financial choices. You will discover how to reshape your fundamental relationship with wealth, secure true personal freedom, and avoid the invisible mental traps that consistently ruin even the brightest minds. Let us embark together on this fascinating, eye-opening journey into the human mind and its complex, lifelong dance with money. Point 1. The crazy things we do with money. Have you ever looked at someone else's financial decisions and thought they were completely out of their mind? It turns out that what seems completely irrational to you might make perfect logical sense to them based on the unique life they have lived. To truly understand the psychology of money, we must first accept a very humbling reality about human nature. No one is actually crazy, even when they are doing seemingly bizarre things with their hard-earned cash. To illustrate this profound point, we can look at the incredible contrasting lives of two very different men, Ronald Read and Richard Fuscone. Ronald Read was a humble, quiet man who worked for decades as a gas station attendant and a janitor at a JCPenney department store in rural Vermont. He chopped his own firewood, wore old coats held together with safety pins, and enjoyed a remarkably simple life. When he passed away at the age of 92, his friends and family were absolutely stunned to discover that this unassuming janitor had amassed an incredible personal fortune of over $8 million. He had simply saved what little he could, invested it in high-quality blue-chip stocks, and patiently waited for decades as the magic of compounding did its work. He left the majority of his millions to his local hospital and library. On the complete opposite end of the spectrum, we have Richard Fuscone. He was everything Ronald Read was not. He was educated at Harvard University, possessed a brilliant analytical mind, and rose to the prestigious position of an executive at the financial powerhouse Merrill Lynch. He was so incredibly successful in the traditional sense that he retired in his 40s to pursue a life of extreme luxury. He borrowed heavily to expand an enormous 18,000 square foot mansion in Connecticut that featured 2 elevators, 2 pools, and 7 garages. He was, by all societal metrics, a financial genius. Yet, when the devastating global financial crisis struck in 2008, Fuscone's heavily leveraged empire completely collapsed. He lost everything and was forced to declare devastating personal bankruptcy, eventually having his beloved mansion sold in a foreclosure auction for a mere fraction of its original cost. How does a janitor with no formal financial education drastically outperform a highly educated Wall Street executive? The answer lies at the very heart of this book. Financial success is not a hard science. It is a soft skill where how you behave is significantly more important than what you know. Fusco knew all the complex math, but he lacked the behavioral discipline and emotional stability that Reed possessed in abundance. Yet, even when we understand this, we still heavily judge the financial behaviors of others. We look at people making seemingly terrible financial choices and assume they are simply foolish. But human beings do not operate in a vacuum. Every single person on this planet has a completely unique view of how the world works, shaped entirely by their own distinct set of life experiences. What you have personally experienced in your life makes up perhaps a tiny fraction of 1% of everything that has ever happened in the world, but it accounts for roughly 80% of how you believe the world truly functions. Consider the generational differences in how people view the stock market or the economy. If you were born in the United States in the year 1950, the stock market remained practically flat during your most formative young adult years. You grew up watching the market stagnate, learning on a deeply emotional level that investing in stocks was a frustrating and relatively fruitless endeavor. However, if you were born just 20 years later in 1970, your young adult years coincided with one of the most explosive, lucrative bull markets in the history of the world. You learned, down to your very bones, that the stock market is an incredible wealth-generating machine. Both groups of people are looking at the exact same mathematical asset class, yet they draw completely different behavioral conclusions because their personal lived experiences are vastly different. This concept extends far beyond just generational divides. It perfectly explains the daily financial habits that leave us scratching our heads. Take, for example, the phenomenon of low-income individuals spending billions of dollars every single year on lottery tickets. To someone sitting comfortably in the middle or upper class, buying a lottery ticket is a mathematically terrible decision. The odds of winning are astronomically low, and that money could easily be saved or invested for a guaranteed return over time. From a purely logical, spreadsheet-driven perspective, buying lottery tickets is crazy. But if you actually pause to listen to the psychological reasoning behind this behavior, a completely different picture emerges. Many people living paycheck to paycheck feel entirely locked out of the traditional American dream. They cannot afford to send their children to prestigious colleges, they cannot afford high-quality health care, and they certainly cannot afford to buy a beautiful home in a safe neighborhood. When they purchase a lottery ticket, they are not necessarily buying a mathematically sound financial asset. They are buying a fleeting psychological moment of hope. They are purchasing the only tangible piece of the dream they can afford. That small slip of paper buys the few days of imagining a life where all their crushing financial burdens are magically lifted. You do not have to agree with this behavior, and you certainly do not have to participate in it, but recognizing the deep emotional logic behind it is the very first step to understanding the psychology of money. We are all heavily biased by our own unique histories. The person who grew up in extreme poverty during a harsh economic depression will never, ever view a dollar bill the same way as the person who grew up in extreme wealth during a booming economic expansion. They will have different fears, different goals, different risk tolerances, and completely different definitions of what constitutes a safe investment. Therefore, the most important lesson we can internalize early on is a profound sense of empathy, both for others and for ourselves. When you see someone making a financial move that you disagree with, pause before you judge. Realize that their personal spreadsheet contains completely different emotional variables than yours. By accepting that no one is actually crazy, we open our minds to the vast, complex, and beautiful spectrum of human behavior that dictates the flow of wealth in our world. Point 2. The invisible hands of luck and risk. We absolutely love to attribute massive financial success to sheer hard work, relentless dedication, and brilliant intellect. Yet we rarely pause to acknowledge the silent parallel forces that secretly govern our world: the overwhelming power of luck and its equally unpredictable sibling, risk. Every single financial outcome in life is deeply influenced by forces completely outside of our individual control. But our egos desperately want to believe that we are the sole authors of our destinies. To truly grasp the staggering magnitude of luck, we must look at the legendary origin story of one of the wealthiest and most successful men in human history, Bill Gates. The story of Bill Gates is often told as a triumph of unmatched genius and relentless entrepreneurial spirit. He was incredibly smart, he worked unimaginably hard, and he had a brilliant vision for the future of personal computing. All of those things are absolutely true. However, there is an invisible layer to his story that is rarely discussed with the same level of enthusiasm. In the late 1960s, Bill Gates attended Lakeside School, an exclusive private prep school in Seattle. What made Lakeside School completely unique was not just its rigorous academic curriculum, but the astonishing fact that it possessed a state-of-the-art computer terminal. At a time when most prestigious university graduate schools did not even have access to computers, this small high school had one. The Mothers Club at the school had used the proceeds from an annual rummage sale to lease an incredibly advanced teletype machine connected to a mainframe computer. Bill Gates was given unlimited access to this machine when he was just 13 years old. Let us break down the sheer mathematical improbability of this situation. In the year 1968, there were roughly 303 million high school-age people in the world. According to Morgan Housel's calculations, about 18 million of them lived in the United States. Of those 18 million, roughly 270,000 lived in Washington state. Of those 270,000, maybe 100,000 lived in the Seattle area. And of those 100,000, only about 300 attended Lakeside School. Bill Gates was one of those 300 students. He experienced a 1 in a million stroke of pure, unadulterated luck to be in the exact right place at the exact right time with the exact right technology that would ultimately define his entire life. Gates himself has openly admitted that if there had been no Lakeside School, there would have been no Microsoft. But the story of Lakeside School holds another, much darker lesson about the flip side of luck, which is risk. Bill Gates had a best friend at Lakeside named Kent Evans. Kent was equally brilliant, equally obsessed with computers, and shared Gates's burning entrepreneurial ambitions. They spent endless hours together writing code, dreaming of the future, and planning the businesses they would one day build. Kent Evans had the exact same 1 in a million luck that Bill Gates had by attending Lakeside. But Kent Evans never got the chance to build Microsoft. Before he even graduated high school, Kent tragically died in an extremely rare mountaineering accident. The odds of a high school student dying on a mountain in a mountaineering accident are astronomically low, essentially a 1 in a million risk. Luck and risk are two sides of the exact same coin. They are the undeniable reality that the world is far too complex to allow 100% of your actions to dictate 100% of your outcomes. When Bill Gates experienced his 1 in a million stroke of luck, he was propelled to global dominance. When Kent Evans experienced his 1 in a million stroke of risk, his extraordinary potential was instantly extinguished. We cannot look at the success of Microsoft without acknowledging both the genius of its founder and the profound, invisible hand of luck that placed him at that computer terminal. Why is this specific concept so incredibly crucial for our own financial journeys? Because we have a very dangerous habit of studying extreme outliers. We look at the billionaires, the legendary investors, and the massive corporate titans, and we try to reverse engineer their success. We buy books about their morning routines, we study their daily habits, and we try to copy their investment portfolios. But we fundamentally fail to realize that extreme success is almost always a combination of extreme skill and extreme luck. You can wake up at 4 in the morning every single day, drink the exact same green smoothie as a billionaire, and read the exact same books. But you cannot replicate the completely random luck that placed them in front of a unique opportunity at the perfect moment in history. When we fail to acknowledge the powerful role of luck, we also become incredibly harsh judges of ourselves and others. When things go spectacularly well for us, our egos immediately step in and say, I earned this. I am brilliant. I made all the right choices. We completely ignore the tailwinds that helped push us forward. Conversely, when things go terribly wrong, we are quick to blame external circumstances, or worse, we internalize the failure and believe we are fundamentally flawed. This dangerous illusion also applies to how we judge businesses. Consider the legendary story of Yahoo turning down the opportunity to buy Google for a relatively tiny sum of money in the early days of the internet. Today, corporate history books mock Yahoo's executives as foolish and short-sighted. Yet, at the time, their decision was based on perfectly rational analysis. The risk simply did not pan out in their favor. If the dot-com bubble had burst slightly differently, those same executives might have been hailed as brilliant risk managers who avoided overpaying for a search engine. The line between a bold, visionary decision and a reckless, foolish mistake is often only visible in hindsight, heavily blurred by the ultimate outcome. Therefore, the most practical, actionable advice we can take from understanding luck and risk is to focus deeply on broad patterns rather than specific individuals. Instead of trying to blindly copy the exact career path of a specific billionaire, look at the broader behavioral patterns of successful people over long periods of time. Broad patterns like consistently living below your means, avoiding catastrophic debt, and maintaining emotional stability during market crashes are highly replicable. They do not rely on a 1 in a million stroke of luck. By acknowledging that luck and risk are always present in the room, we can become much more forgiving of our own financial failures, much more humble about our own financial successes, and significantly better equipped to navigate the unpredictable waters of the global economy. Point 3, the deadly trap of never having enough. There is a dark, highly destructive side to human ambition that rarely gets talked about in traditional finance books. It is the dangerous, intoxicating illusion that whatever amount of money, power, or prestige you currently have is simply not enough. In a world completely obsessed with aggressive growth and limitless accumulation, the single hardest financial skill to master is getting the goalpost to stop moving. If you cannot define what enough means to you, you are destined to eventually destroy everything you have built. To fully understand the catastrophic consequences of this psychological trap, we must examine the tragic downfall of Rajat Gupta. By any conceivable metric, Rajat Gupta was one of the most successful and powerful business executives in the entire world. Born into incredibly humble beginnings in Kolkata, India, he was orphaned as a teenager. Through sheer brilliance and relentless hard work, he earned his way into prestigious universities and eventually rose to become the highly respected CEO of McKinsey & Company, the premier global consulting firm. He retired highly decorated, sitting on directors for massive institutions like Goldman Sachs and Procter & Gamble. He was deeply involved in global philanthropy and was universally admired by his peers. By the year 2008, Rajat Gupta had accumulated a personal net worth of roughly $100 million. Let us pause and truly think about what $100 million actually means. With that amount of money, Gupta could have easily funded a lavish lifestyle for himself, his children, his grandchildren, and his great-grandchildren without ever having to work another day in his life. He had won the financial game of life completely and unequivocally. But there was a fatal flaw in his psychological makeup. For Rajat Gupta, $100 million was simply not enough. He did not want to be a mere centimillionaire. He desperately wanted to join the exclusive, highly coveted club of billionaires. He wanted to be a certified billionaire with a capital B. This burning, insatiable desire for more blinded him to the incredible risks he was taking. During the chaotic depths of the 2008 financial crisis, while serving on the board of Goldman Sachs, Gupta learned highly confidential information that Warren Buffett was about to inject $5 billion into the struggling bank. This was a massive market-moving secret. Instead of keeping his fiduciary duty, Gupta immediately hung up the phone and illegally called his friend, a hedge fund manager named Raj Rajaratnam, to pass along the insider information. That single foolish phone call, lasting barely 16 seconds, completely destroyed Rajat Gupta's entire life. He was caught, convicted of insider trading, stripped of his stellar reputation, heavily fined, and sent to federal prison. He risked immense wealth, a pristine reputation, and his personal freedom, all for a little bit more money that he absolutely did not need. He had no sense of enough. Gupta's story is extreme, but the underlying psychological disease affects almost everyone to some degree. We also see it in the infamous case of Bernie Madoff. Before Madoff orchestrated the largest, most devastating Ponzi scheme in human history, he actually ran a highly successful, completely legitimate market-making business. He was making tens of millions of dollars legally. Yet the relentless desire for more, the need to maintain a facade of infallible success, drove him to commit unimaginable financial crimes. Both men had everything, yet they risked it all for things they did not need, simply because their goalposts never stopped moving. Why is it so incredibly difficult for humans to be satisfied? The root cause is the deeply ingrained psychological mechanism of social comparison. We do not evaluate our wealth in absolute terms. We evaluate it strictly relative to the people around us. When you are a rookie junior analyst making $50,000 a year, your goal is to make $100,000 like the senior analyst. When you make $100,000, you look at the manager making $250,000. When you make $250,000, you look at the regional director making $1 million. And when you make $1 million, you start hanging out with people who make $10 million. Morgan Housel compares this endless cycle to looking up at a ceiling in a Las Vegas casino. The ceiling just keeps going up and up, creating an illusion of infinite space. If you tie your happiness and your definition of financial success to having more than the person standing next to you, you are playing a game that is mathematically impossible to win. There will absolutely always be someone richer, more successful, or more famous than you. The only guaranteed way to win the brutal game of social comparison is to refuse to play it in the first place. Building a healthy relationship with wealth absolutely requires defining your personal enough. Enough does not mean you have to embrace extreme minimalism, live in a tiny cabin in the woods, or stop striving for career advancement. Enough simply means realizing that an insatiable appetite for more will eventually push you to a point of profound regret. It means recognizing the exact point where working an extra 10 hours a week or taking on a massive amount of high-stress debt to buy a slightly larger house actively subtracts from your overall quality of life rather than adding to it. There are certain things in life that are utterly invaluable and should never, ever be risked, regardless of the potential financial upside. Your stellar reputation is invaluable. Your personal freedom and autonomy are invaluable. Your beloved family and your deep friendships are invaluable. Being loved by the people you actually want to love you is invaluable. Your physical and mental health are invaluable. The only way to fiercely protect these precious assets is to cultivate the remarkable superpower of knowing when it is time to stop moving the goalpost. When you finally learn to say, "I have enough," you instantly neutralize one of the most destructive psychological traps in the modern financial world. Point 4, the mind-boggling magic of continuous compounding. When we think about building massive wealth, our brains naturally default to searching for the highest possible investment returns. We obsessively look for the next hot technology stock, the secret cryptocurrency that will explode overnight, or the brilliant trading strategy that will double our money in a month. But the true, undeniable secret to unimaginable wealth lies in something far more boring, incredibly profound, and deeply counterintuitive: the sheer, unbreakable persistence of time. To understand wealth, we must understand the mind-boggling magic of continuous compounding. Morgan Housel illustrates the power of compounding by taking us completely out of the financial world and plunging us into the fascinating science of the Earth's glacial history. For centuries, brilliant scientists could not figure out what caused the massive ice ages that periodically covered our planet in miles of thick, crushing ice. They assumed there must have been catastrophic, earth-shattering events, massive volcanic eruptions blocking out the sun, or dramatic shifts in the Earth's orbit that plunged the planet into sudden, deep freezing temperatures. However, a brilliant Serbian scientist named Milutin Milankovic finally cracked the code, and his discovery is a perfect metaphor for building wealth. He realized that the ice ages were not caused by brutally cold, freezing winters. Instead, they were caused by surprisingly mild summers. Here is how the astonishing process works. A slightly cooler than average summer fails to melt all of the snow that fell during the previous winter. When the next winter arrives, it lays a fresh layer of snow on top of the leftover snow from the previous year. This thin, leftover layer of snow makes the ground slightly more reflective, which bounces a tiny bit more of the sun's warm rays back into space. This slight cooling effect makes the following summer even cooler, which ensures that even more snow survives the melt. This tiny, seemingly insignificant cycle repeats year after year, decade after decade. A thin, fragile layer of leftover snow compounds upon itself. Over tens of thousands of years, that tiny layer of snow transforms into a massive continental ice sheet miles thick, capable of carving out gigantic valleys and reshaping the entire face of the Earth. The ice ages were not created by sudden, violent catastrophes. They were created by the slow, relentless, unstoppable compounding of small, leftover amounts of snow. This exact same mathematical principle is the absolute core foundation of the greatest financial fortune in modern history. We all know the name Warren Buffett. There are literally thousands of books dissecting his investment strategies, his ability to read balance sheets, and his brilliant management style. But the most important, undeniable fact about Warren Buffett's wealth is almost entirely ignored by the general public. As of the writing of Morgan Housel's book, Warren Buffett's net worth was roughly $84.5 billion. But here is the magnificent, mind-blowing statistic. Slightly more than $81.5 billion of that total net worth came after his 65th birthday. Let that staggering fact sink in for a moment. The vast, overwhelming majority of the greatest investors' wealth was not the result of early, wildly high returns. It was the result of him starting to invest when he was just 10 years old and continuing to let that money compound, uninterrupted, for 3/4 of a century. Buffett's secret is not just that he is a brilliant investor. His true secret is that he has been a consistently good investor for an absurdly long period of time. Time is the secret sauce that makes compounding explode into unimaginable numbers. To highlight this further, look at Jim Simons, the famously secretive founder of the Renaissance Technologies hedge fund. Jim Simons is mathematically the greatest investor who has ever lived. He compounded money at an astonishing rate of roughly 66% annually for decades. No one else even comes close. Warren Buffett's annual returns hover around 22%. Yet, Jim Simons' net worth is a fraction of Warren Buffett's. Why? Because Jim Simons did not find his investment stride until he was 50 years old. If Jim Simons had started investing at age 10 and earned his 66% annual return, his net worth would not just be billions, it would be mathematically impossible numbers that would break the global economy. The reason this concept is so incredibly difficult for us to grasp is that the human brain is simply not wired to process exponential growth. We think linearly. If I tell you to take 9 steps forward, you can easily visualize exactly where you will be in the room. But if I tell you to take 9 exponential steps, where each step doubles the length of the previous one, your brain short circuits. You cannot intuitively grasp that 9 exponential steps will take you miles away. Compounding is not intuitive, which means we consistently underestimate its profound power. Because we underestimate it, we constantly interrupt it. We get bored with holding a steady index fund, so we sell it to buy something more exciting. We get terrified during a temporary market crash, so we pull all our money out in a panic, completely resetting the compounding clock. We fail to realize that the most powerful thing we can do in finance is to simply let the snow accumulate. The profound magic of compounding does not only apply to money, it applies to every single facet of human life. It applies to building deep, meaningful relationships. When you spend small, consistent moments of quality time with a partner over decades, the trust and intimacy compound into an unbreakable bond. It applies to acquiring new, valuable skills. Reading just 10 pages of a book every single day seems utterly insignificant in the moment, but compounded over 20 years, it results in a massive, unparalleled reservoir of knowledge. The ultimate lesson of compounding is one of extreme patience and profound discipline. You do not need extraordinary, record-breaking returns to become wealthy. You do not need to take wildly dangerous risks. You simply need good, consistent returns that you can reliably sustain for the longest possible period of time. When you finally stop trying to forcefully accelerate the wealth building process and instead allow the relentless magic of time to do the heavy lifting, you align yourself with the single most powerful mathematical force in the universe. Point 5. The delicate art of surviving and keeping wealth. There is a massive fundamental difference between getting money and keeping money. They are two entirely different skill sets that require completely opposing psychological mindsets. Getting money usually requires taking bold risks, being fiercely optimistic, putting yourself out there in the world, and embracing the unpredictable unknown. But keeping money? Keeping money requires the exact opposite. It demands a healthy dose of humility, a constant nagging fear that what you have made can be taken away from you, and a deep, unshakable focus on survival. History is absolutely littered with brilliant, highly ambitious people who completely mastered the art of getting wealthy, but utterly failed at the delicate art of staying wealthy. Perhaps the most dramatic example of this is the legendary stock trader Jesse Livermore. In the early 20th century, Livermore was arguably the greatest, most intuitive stock market trader alive. By the time the roaring 1920s came to a close, he had amassed a staggering personal fortune. Then came the catastrophic stock market crash of October 1929, an event that wiped out a massive portion of the world's wealth and triggered the Great Depression. During that terrifying week in October, as the market completely collapsed and desperate Wall Street traders were literally jumping out of office windows, Jesse Livermore's wife sat at home in a state of absolute panic. When Livermore finally walked through the front door, she was crying, bracing herself for the devastating news that they had lost everything. Instead, Livermore calmly told her the truth. He had aggressively shorted the market. He had bet heavily that stocks would fall. While the rest of the world was seeing everything, Jesse Livermore made the equivalent of over $3 billion in a single day. He emerged from the crash as one of the richest, most powerful men on the entire planet. He had brilliantly executed the getting money phase. But what happened next perfectly illustrates the devastating danger of lacking a survival mindset. Flush with unparalleled wealth and practically overflowing with unchecked ego, Livermore felt completely invincible. He believed he possessed a magical touch that could never fail. He continued to make massive, highly leveraged, incredibly risky bets in the stock market. Over the next 4 years, his luck brutally reversed. He lost everything. By 1933, the man who had conquered the Great Crash was completely broke, deeply depressed, and tragically ended his own life. Jesse Livermore failed to realize that the skills required to build a massive fortune are not the same skills required to protect it. To keep wealth, you must embrace the profound concept of survival. Survival does not sound glamorous or exciting, but it is the absolute bedrock of all long-term financial success. You cannot benefit from the mind-boggling magic of compounding if you do not survive long enough for it to work. A survival mindset relies entirely on three critical pillars. The first pillar is being financially unbreakable. This means structuring your life and your portfolio in a way that virtually guarantees you can withstand inevitable market crashes, unexpected job losses, or sudden medical emergencies without being forced to sell your investments at the worst possible time. It means deliberately carrying less debt than you theoretically could. It means holding a significantly larger cash buffer than traditional finance textbooks might recommend. Cash is the oxygen of financial independence. It is the ultimate shock absorber that prevents a temporary setback from becoming a permanent catastrophe. The second pillar is being psychologically unbreakable. It is not enough to just have the math right. Your mind must be prepared for extreme volatility. When the stock market drops by 30%, which it historically does on a regular basis, your brain will scream at you to panic, to sell everything, to run for the hills. A survival mindset means deeply accepting that volatility is not a fine you pay for making a mistake. It is simply the natural fee of admission to the great wealth-building amusement park. If you cannot emotionally survive the terrifying drops, you will never be around to enjoy the thrilling highs. The third pillar is recognizing the supreme importance of leaving room for error. We often make rigid, highly detailed financial plans that assume our lives will progress in a perfectly straight, predictable line. We assume we will always earn the same salary, that inflation will stay perfectly low, and that the stock market will smoothly return 8% every single year. But the real world is incredibly messy, chaotic, and completely indifferent to your beautiful spreadsheets. Leaving room for error means planning for the reality that your plan might not go according to plan. It is acknowledging that you might want to switch to a lower-paying, lower-stress career in 10 years. It is understanding that an unexpected global pandemic could suddenly upend the entire economy. When you shift your ultimate goal from maximizing returns to maximizing survival, your entire relationship with money instantly changes. You stop chasing dangerous speculative bubbles. You stop comparing your portfolio to your neighbors. You realize that the greatest financial achievement is not making a quick $1 million, but rather building an unbreakable financial fortress that allows you to sleep peacefully every single night, completely immune to the chaotic storms of the outside world. Point 6. The paradox of the man in the car. We are profoundly social creatures, biologically wired through millions of years of evolution to seek the respect, admiration, and acceptance of our peers. In the modern world, one of the primary ways we attempt to signal our status and worth to the tribe is through the conspicuous display of wealth. We buy massive houses, expensive designer clothes, and luxury vehicles because we deeply believe that these visible symbols will make other people admire us. Yet, Morgan Housel brilliantly exposes the massive tragic flaw in this logic through what he calls the paradox of the man in the car. When Housel was a young college student, he worked as a valet at a highly exclusive, luxurious hotel in Los Angeles. Every single day, incredibly wealthy guests would pull up to the front entrance, driving breathtaking, exotic cars, gleaming Ferraris, roaring Lamborghinis, and pristine Rolls-Royces. Housel admits that whenever one of these magnificent cars drove up, he would immediately stop what he was doing and stare in absolute awe. But here is the profound psychological twist. He realized that he never, not even once, actually looked at the driver of the car. He was completely captivated by the beautiful machine itself, and he simply imagined himself sitting in the driver's seat, imagining how much people would admire him if he owned that car. This is the great paradox of visible wealth. The person driving the $200,000 Ferrari bought that car because they desperately wanted people to look at them, to respect them, and to think they were incredibly important. But the people on the sidewalk are not looking at the driver. They are ignoring the driver entirely and simply using the car as a mirror to reflect their own burning desire for wealth and admiration. We spend immense amounts of our hard-earned money trying to buy respect from strangers, completely failing to realize that those strangers do not care about us. They only care about their own fantasies. This powerful realization forces us to confront the critical, fundamental difference between being rich and being wealthy. In our society, we use these two words interchangeably, but they represent entirely different concepts. Being rich is a current state of highly visible income. The person driving a brand new Porsche and living in a massive, beautifully decorated mansion is undoubtedly rich. They have a high enough current income to afford the monthly payments on those highly visible luxury items. It is incredibly easy to spot rich people because they go out of their way to make sure you see them. Wealth, on the other hand, is completely hidden. Wealth is the $200,000 luxury car that was never purchased. Wealth is the massive, sprawling mansion that was never upgraded to. Wealth is the expensive diamonds not bought, the first-class upgrades declined, and the flashy watches left in the store window. Wealth is highly liquid financial assets, cash in the bank, index funds growing quietly in a brokerage account, and completely paid off mortgages. Because wealth is entirely invisible, it is incredibly difficult for us to learn how to build it. We are constantly bombarded by the visible, flashy displays of being rich, but we never see the quiet, disciplined restraint of being wealthy. Housel beautifully compares building wealth to losing weight and eating a healthy diet. Earning a high salary is like vigorously exercising. It burns a lot of calories and makes you feel incredibly strong. But buying expensive luxury items is like eating a massive, calorie-dense chocolate cake right after you finish your workout. It completely negates all of your hard work. Wealth is not the exercise. Wealth is the incredibly difficult discipline of turning down the cake. It is the calories you actively choose not to consume. When you truly internalize the paradox of the man in the car, you suddenly realize that spending money to show people how much money you have is the absolute fastest way to have less money. True respect and genuine admiration from others rarely come from the expensive brand names draped across your shoulders. Genuine respect is earned through profound humility, quiet kindness, deep empathy, and undeniable competence. A flashy car might buy you a fleeting glance of envy from a stranger at a stoplight, but it will never buy you the deep, meaningful respect of the people who actually matter in your life. The ultimate goal of accumulating wealth is not to buy an overwhelming amount of expensive stuff. The greatest, absolute highest dividend that money can ever pay is the ability to drastically control your own time. When you possess massive hidden wealth, you possess the ultimate superpower, the ability to wake up every single morning, look in the mirror, and confidently say, I can do absolutely whatever I want today. You can choose to walk away from a toxic boss. You can choose to take a year off to care for a sick relative. You can choose to start a risky new business without the terrifying fear of starvation. Hidden wealth buys you flexibility, autonomy, and the profound peace of mind that no luxury car in the world could ever hope to provide. Point 7. The conclusion. As we reach the final stages of our deep dive into the complex psychology of money, we must confront one of the most bizarre and pervasive quirks of the human mind: our strange, almost intoxicating attraction to pessimism. In the world of finance, economics, and predicting the future, optimism is frequently dismissed as naive, foolish, and dangerously blind to reality. Pessimism, on the other hand, just sounds incredibly smart. If you stand on a stage and confidently predict that the economy will grow steadily over the next 20 years, people will likely ignore you. But if you stand on that same stage and vividly predict a catastrophic market crash, a devastating global recession, and the imminent collapse of the currency, people will pull up a chair, lean in, and treat you like a profound intellectual prophet. Why are we so deeply seduced by bad news? The answer lies rooted in our evolutionary biology. Symmetrical loss aversion is a well-documented psychological phenomenon where the painful sting of losing something is felt significantly more intensely than the joyous pleasure of gaining the exact same thing. Our ancient ancestors, who were hyper-vigilant to the pessimistic threat of a tiger hiding in the bushes, survived to pass on their genes, while the blindly optimistic ancestors who assumed the bushes were clear did not. We are hardwired to pay extreme attention to threats. The media deeply understands this biological vulnerability and ruthlessly exploits it. Bad news happens incredibly fast. A stock market crash takes days, a devastating hurricane takes hours, a massive corporate bankruptcy takes minutes. Because it happens so quickly, it dominates the daily headlines. Good news, however, happens agonizingly slowly. The steady decline of global poverty, the slow, miraculous curing of diseases, and the quiet, persistent compounding of massive economic growth take decades to unfold. They lack the sudden, violent drama required to capture our incredibly short attention spans. For example, consider the remarkable invention of the airplane. When the Wright brothers finally achieved the impossible dream of human flight in 1903, it was arguably one of the most monumental technological breakthroughs in the history of the world. Yet it took years for the mainstream media to even care or report on it significantly. But when a modern airplane tragically crashes, it is breaking news around the entire globe within minutes. We are completely surrounded by a pessimistic bias that constantly tells us the world is falling apart. To successfully navigate this pessimistic noise and build lasting wealth, we must actively cultivate a deeply balanced mindset. We must be optimistic about the long-term future while maintaining a healthy, paranoid pessimism about the short-term journey. And the only practical way to bridge the gap between short-term paranoia and long-term optimism is to strictly enforce a massive margin of safety, or as Housel calls it, leaving room for error. Leaving room for error is not about being overly conservative or terrified of taking risks. It is the profound acknowledgement that uncertainty, randomness, and unpredictable chaos are permanent, unavoidable features of the human experience. Look at the incredibly fascinating world of professional blackjack card counters. A professional card counter does not possess a magical crystal ball that tells them exactly what the next card out of the shoe will be. They completely acknowledge the randomness of the deck. What they do is calculate the slight mathematical edge they have when the deck is rich in high cards. But even with that mathematical edge, they know they will inevitably face devastating losing streaks due to pure bad luck. To survive these inevitable bad streaks, they must have a massive bankroll, a literal margin of safety that prevents them from going completely broke before the mathematical odds finally turn in their favor. In your personal financial life, your margin of safety is your cash savings, your emergency fund, and your strict refusal to over-leverage yourself with crushing debt. It is the incredibly humble acceptance of the end of history illusion. This psychological illusion is our stubborn tendency to believe that the person we are today is the final, finished version of ourselves. We confidently make rigid, inflexible financial plans for 20 years in the future, completely ignoring the undeniable fact that our desires, our values, and our goals will drastically change as we age. The ambitious 25-year-old who wants to work 80 hours a week to become a millionaire might completely transform into a 35-year-old parent who desperately wants to take a massive pay cut just to spend more time at home with their children. If your financial plan is completely rigid and relies on everything going perfectly according to the spreadsheet, it is a fragile, dangerous plan. A robust financial plan leaves massive room for error. It allows you to change your mind. It allows you to pivot careers. It allows you to comfortably survive a sudden economic depression without breaking a sweat. Ultimately, the psychology of money teaches us that the ultimate goal of managing our finances is not to become a cold, calculating, perfectly rational robot. Humans are deeply emotional, beautifully flawed, highly complex creatures. We do not need a financial strategy that mathematically maximizes every single penny of potential returns. We need a financial strategy that allows us to sleep peacefully at night. We need a strategy that is broadly reasonable, even if it is not strictly mathematically rational. When we finally understand the profound impact of our own history, the silent power of luck, the deadly trap of never having enough, and the supreme importance of controlling our own time, we unlock the true, deeply liberating psychology of wealth.
You made it to the end. Great job. Did you find the secret messages hidden inside? If you listened carefully, your life is already changing. Your decision-making is getting better. Your problem-solving is stronger. Your leadership and communication are improving. Your thinking ability is growing every day. Now do these 3 things. 1. Subscribe so you don't miss more secret messages. 2. Like this video. Help others find it too. 3. Share. Send this to one person you love. That person can change their life as well. Keep listening. Keep finding secrets. See you next time. Bye for now.